Good afternoon, viewers. This is your tutor CPH House Cafe, and today we are going to resume our series on financial reporting. And what we are going to look at today is IAS 37, that is provisions, contingent liabilities, and contingent assets. Basically, we are going to look at three things. One is a provision, the other one is contingent liability and a contingent asset. And how are we going to be accounting for them? That's also basically important. And before we proceed to the notices we have, one of the things you have to understand is that when we are talking about these provisions, basically I'm going to start with the provision, then later on I go with the contingent one by one, because they are separate and they are more or less correlated. So when I start with the provision, what you have to understand within this provision is that you can take an example. If let's say it is a manufacturing company, and that company, let's say, deals in tinned food, or it is dealing in electronics, and you may find that they have an arrangement with, let's say, the wholesalers, these people who buy items in large numbers. What will happen is that when these wholesalers are buying the goods, they come and they bargain on the price. Most of those items, they are not tested at the point of purchase. So by the time they pack the items and they take them, they deliver to their premises, I'm talking about the wholesalers, these companies, since the buyers, they are not testing those items before they take them, the company or the manufacturing company itself makes some provisions. In other words, it sets aside certain incomes that are going to be incurred, maybe in repairing those defects that are going to be discovered by the wholesaler when the person is selling them, or maybe a retailer when they're selling them out. So how do we account for that money we are going to be setting aside, maybe to cater for those repairs, if at all some of the items that were sold have defects or have damages and they are going to be returned to the company for repairs? So a company, what it does, if at all there have been some warranties, you may find that these items are brought back and they do some repairs. So when they are doing repairs, they are of course incurring costs. So before you expect that you are going to be making 100% sales, at least you have to set some money aside to cater for those uncertainties that may arise as when you are processing those items, because not all the products we are going to be manufacturing are going to be coming out working well. So that's basically how we look at these provisions, and that's how they come into existence. But how do we account for them? How do we know that we have these provisions? Then the other one is, most of the times we've been accounting for bad debts and whatever, but when you're talking about this standard, we are not going to be going into that component. But what we can only pick from that is that a provision is an estimate. It's something that we just assume that it will happen. So even if we have made an assumption, doesn't mean that that assumption is going to be 100% true. But we are going to be we are going to see the recognition criteria of how we recognize that at least from this scenario we can make a provision, or we can recognize and call it a provision. If something is not called a provision, then it means it is going to be just a liability. When you're talking about these contingent liabilities, we are talking about the liabilities there is a possibility for them. These are potential liabilities or obligations that are going to be coming to the entity. But the logic is, are we sure that those contingent liabilities are going to be existing? Most of the times you find that if they are just one-off item, you find that maybe their percentages is not probable. You can't just make a decision and you say we are going to be having a contingent liability. It is the opposite is the one for the contingent asset. Of course, we are expecting some money to come in, but it's also, yes, we are expecting that maybe if at all we've got a case and we may end up winning the case. So when we win the case, we expect at least to be refunded back some money. So we expect that we are going to be getting something, but it's not probable that we are going to be having such kinds of items. So we are going to be looking at how are we accounting for that items. Then maybe the last one is when there is restructuring within the organization. We are changing the way we've been operating. We are maybe closing off some of the branches. How are we going to deal with the employees that have been working there? How are we going to do? Are we going to compensate for the terminations of their contracts? Are we going to make them redundant and they be there, we start incurring redundancy costs? So we have to make a provision if you have to go into the restructuring. But let's first go through these slides and we see what items are included in which item, and we'll be able to account for that. But that's basically an overview of what we are going to be seeing today. If we start by the provisions, according to the standard of IAS 37 says that these provisions, they are liabilities of uncertain timing. It is uncertain timing or amount, but not saying it is uncertain timing and amount. No, it is only a situation where one thing can occur at a time. It may be that we don't know the time when those expenses are going to be incurred, or we don't actually know which amount are we going to be incurring for those uncertainties. So it is either of that. It may be we don't know the time or we don't know the amount, but it can't be both. So this is a liability of uncertain timing or amount. That is the definition according to IAS 37, and that's basically what we can consider as far as provisions are concerned. So we try to look at what are some of the recognition criteria. How do you tell that we have a provision? One, and this one is very important, there are 3 criteria that we base on to confirm that we are supposed to recognize a provision in our books. And one, we are saying that there is a present obligation of an entity arising from past event. It is a present obligation. Remember, here we are talking about liabilities, meaning it is the company that is going to be spending out money to cater for those uncertainties that may be coming in the future, or whichever amount we are going to be paying. So if it is a present obligation of an entity arising from past event, meaning it is something that we already incurred. If, let's say, we have supplied the goods, but some of them are defects, the retailers or the wholesalers are going to bring those goods back and we try to do the repairs, or we exchange and give them the new ones. So if we are saying that these obligations can be legal or constructive. It can't be both. It is either legal or it is a constructive. Something that is legal, it means it is arising out of the laws. It may be out of the law that you have a court case. It may be out of the regulations, that it is the regulators who are engaging into the operations. It may be in terms of these contracts these companies are signing with other partners that you are going to be doing business with. You may find that you have, let's say, a contract with, let's say, the suppliers of certain items, and there are some legal obligations that may arise as we are doing our work. So we reach at an extent, and we say, if we expect that we are going to be incurring these costs of, let's say, one of the suppliers has taken us to court and we are expected to lose a certain amount, and we are sure that we can be able to pay that amount, then we can be able to recognize, and we say it is arising as a result of the legal practices. And the other one, it is constructive in a way that we are just looking at what are the things that management has done, or what are the things that are within our policies that are maybe arising, or that are causing those costs that we are incurring. Maybe we had an agreement with the, let's say, supplier, and the management agreed that we are going to be giving them maybe discounts, and we fail to honor that. Or we had certain repayment periods that we are violating with maybe the people who have supplied us, let's say, funds and other creditors. So these constructive ideas, they are just constructed by the management, or they are just within the policies. And the other one, it may be even the past actions. It may be the past practices. What are we been doing? If, let's say, we've been giving employees maybe their Christmas period, and we give them Christmas packages, these employees are going to be expecting that maybe at the end of every year we are receiving something. So you'll find employees are asking that whenever the year is about to end, they will be asking, are we going to be receiving this? Because the company used to do that, so people think that it's going to be there for forever, which means that thing is creating an expectation within the third parties, and it needs to be accounted for. And how are we going to be accounting for it? We are only going to make a provision that during the end of the financial year, or during the Christmas periods, we always give these out. Maybe you may find that the company has been doing some charity work. It has been donating some money to, let's say, certain organizations, and these organizations, they have been receiving that money maybe for the last 10 years. So it becomes a normal practice that even these people, they are going to be expecting for every year, they are going to be expecting that, because that's arising as a result of what the company has been doing for the past years. Maybe the last one we can talk about, maybe if the company has been maybe painting certain buildings, or giving road posters and whatever on maybe the road. Maybe they have been painting the road for certain number of years, and the company is going to be expected that every year it's going to be doing that, because it became a practice that every year the company has been doing that for maybe some good number of years. So those are the items that we are going to be looking at. Even the examination is will be seeing that they will give you scenarios that, let's say the company has been providing a certain amount of money to a certain foundation for more than 10 years. So this one, you just look at it that it has been there as a result of the management actions. You can say that we are going to be accounting for the provision because the company has been doing that for the previous years. So that's basically some of the things you are going to be looking at, but make sure you understand this because this is where most of the questions are going to be coming from. If it is not a legal matter, it is going to be a constructive matter, meaning it will be from the actions of the management or the policies of the organization or the practices. So that's basically one of the recognition criteria for recognizing a provision. The other one we can talk about is we are saying the standard says that it's probable that an outflow. Remember, we've been used of talking about it's probable that future economic benefits will flow to the entity, but this time around it is not an asset, we have a liability. It means that we are expecting a certain amount of money to be going out of the company to settle the obligation. We are saying the standard says it's probable that the outflow of resources from the entity will be required to settle the obligation. Meaning, since it is a liability that is going to be arising, we are not recognizing any income, but rather we are giving out money to settle those obligations. And we are saying, if you are looking at this standard IS 37, we have to understand the word probable. If something is probable, we said in the previous videos, we've been saying that something to be probable, it means it is exceeding 50%. The chances of something to occur exceeds 50%. So you'll find if, let's say, there's a certain item, it is just a one-off item, they are not a combined item as we are going to be seeing, you find that you will be given a question and it will be having some percentages that maybe we have a 45% chances of the company winning the case. You may find that lawyers are giving us evidence that according to what is prevailing, we have 45% chances of us winning the case. So it means there we cannot make a provision because it doesn't exceed 50%. So if we have evidence that at least these obligations are going to arise, it means, and that percentage is exceeding 50% for a single item. This percentage doesn't work when the cases are many, or when there are so many things that are being combined at once. It is only for a one-off item. If maybe a customer has taken us to court and we are looking at the chances of us losing the case. Of course, if you are expecting to lose and the chances are more than 50%, we make a provision for that, so that by the time it happens, we have already catered for it. So that's basically what we are talking about, that it is probable that an outflow of resources from the entity will be required to settle the obligation. The last criteria for recognizing a provision is that we are saying that a reliable estimate of the amount of the obligations can be made. Remember, here we said that these obligations, these provisions we are giving out, they are just estimates. We are just making an estimate of what may happen. So we have to be also very keen about whether we can be able to determine the amount. If at all you can't determine the amount, then you can't recognize that as a provision, because which figure are you going to be recording in the financials? Remember, when you are preparing these financial statements, we put in the monetary values. So if you don't have the figures, we can't recognize this as a provision. So we are supposed to be able to determine these estimates, and we can be able to quantify them. When we go to the next slide, it's all about the measurement. How, after knowing that, if we have, after recognizing that the provision is there, which figures are we going to assigning to, how much are we going to be assigning to them when we are taking them to our financials? That's basically what we are going to be looking at under measurement. Saying measurement of provisions, and you are saying that these provisions, they are measured at the best estimate of the expenditures required to settle the obligation. We use the best estimate. How do we determine these best estimates? It depends whether it is a one-off item or it is a large population. Of course, when it is a large population, meaning there are so many cases, this person is suing us, the other one is suing us, the cases are many. So when the cases are many, we don't consider the percentages. And we are saying, if a provision involves a large population, then the amount will be determined by weighting. This word is not weighing. We are not weighing, but we are weighting. We are weighting, or we are summing up. We are summing up all the possible outcomes. I remember, you know how to compute the expected values using your QT knowledge or qualitative techniques. There is where you do you get the probability, you multiply by the possible expenditure or the possible outcome. You get the percentage, the chances of something to occur, multiplied by the expenditure. Then we keep summing up for each. If, let's say, we have so many people that are suing the company, in case of maybe our contracts, we've been dealing with them, you get the chance. Of course, they are supposed to give you the chances of something to occur. They give you the percentage, you multiply by the expenditure. If that happens, how much are we going to be paying? Those two are supposed to be given. So you'll be getting the summation of all those possible outcomes of the transaction. And here we have a simulation. We can maybe try to look at this, and we are saying Pichu Limited sells goods with a warranty where customers are covered for the costs of repair of any manufacturing defects. The company's past experience and future expectations indicate the following. We have the partners, the pattern of the likely occurrence of these repairs. We have the percentage of goods sold, we have the defects, and we have the cost of repairing, if at all those defects happen. We have a 75% of something to occur, of the defects to occur, and we have 75%, we have none, meaning even the cost is zero. Then 20%, they are going to be having minor defects, and if all happens, it means we are going to be paying 40 million. Then 5% of the major, they are going to be having major defects, and if that happens, it means we are going to be paying 160 million. Then they say determine the provision. Of course, to determine the provision, we said we sum up the possible outcomes. How do we get these possible outcomes? We get the percentages of the goods, we multiply by the figure we are going to be incurring if at all that happens. It means it will be 75% times 0 plus 20% times 40 million, then 5% times 160 million, and that will give us, if you sum up all, you'll be getting 16 million. It means that will be our provision. How are we going to account to enter that figure we've got of 16 million? We are going to credit provision for repairs. Of course, we debit the profit and loss because it's going to be as a liability or as an expense we are likely to incur. So that's basically how we treat that if it is a large population. If we said if it is a large population, we don't consider these percentages. You may find that this one we've been saying that the percentage of something to occur must be exceeding 50%, but here we are considering 5%. This one we said if it is a larger population, we don't consider the percentages. We only consider these percentages when it's a one-off item. Maybe they have given you a scenario whereby the company has been dragged to court and they are required to pay maybe 10 million. But they will go ahead and give you the percent that maybe there is a 40% chance of the company losing the what? Of the company losing the case. If at all it is like that, then you compare. If it exceeds 50%, you say we recognize the provision. If it doesn't exceed 50%, then it means we are not going to recognize it. But the question will be, how will you treat that? If it is 40%, are you going to just leave it and say, here I do nothing and you expect to get marks? Then we are going to be seeing how do we treat that if at all it doesn't qualify to be a provision. If it doesn't qualify to be a provision, it means it is a contingent liability. And we shall see how we account for those items. Maybe to proceed, we can try to look at provisions for decommissioning. This decommissioning is most of the time is in the mining and oil refinery. You may find that let's say a given company, let's say a mining company has been given a contract, or it has been allocated a mining site where it is supposed to carry out its mining activities. Of course, they go through their exploration and all that to find whether the site they have been given to them is going to be profitable. Of course, if you don't do that and you just keep mining from anywhere you want, of course, when they are doing mining, they have to first do the exploration, and you find out whether the contract area you are going to be given is going to be beneficial, depending on the number of minerals you've seen that are there. So what will happen is that their costs will incur in the future when we have finished carrying out our mining and we have maybe constructed certain buildings that are going to be used in our mining activities. So at the end of the project, we have to remove everything, dismantling and recovering the surface to the extent that we maintain the ground we found before we started our mining. So all that cost that we are going to incur in the future is going to be accounted for as a provision. But which figures are we going to be recording? Because those figures are going to be incurred in the future, it means that those figures are going to be discounted and we get their present worth now, so that we can be able to incorporate them in our financials. That's basically how we look at the decommissioning or the dismantling and restoration of sites. That one we are going to look at it when we look at the standard of IFRS 6, which does on the exploration and all that are related to the mining and all that. But what we have to know is that costs of dismantling and restoration of sites at the end of the useful life of the project, they are going to be discounted and we get their present worth, so that we can be able to incorporate them in our financial statements. So maybe some students may be asking, why are we recording these decommissioning? Why are we giving decommissioning as a provision? Because it will happen by all means. If you start the project and you accept, you get that contract area and you start your mining, we are going to incur them. So it's like we are going to incur them so long as we start the operation. When we start operation like this, it means we are going to be incurring them. So we better provide for them so that by the time we incur them, we have already accounted for them. So that's how basically we do that. The provision for decommissioning, maybe to get some theoretical aspect, we are saying that this is where an entity acquires a non-current asset and has an obligation to dismantle the asset and restoring the site at the end of the useful life. And we are saying that the cost to be incurred in the future will be discounted to their present worth. That's what I've been talking about. We know how to calculate the present value of a given future amount of money by using our discounting factors. We did that when we are doing IAS 16, that is PPE, because of course we looked at some of those costs that we are going to be incurring in the future. We looked at them. Maybe to look at something different and we'll get more light on the standard, let's try to look at the contingent liabilities. We are saying that these contingent liabilities, we said they are possible or potential obligations that may arise in the future. That may arise, but their occurrence, we are not sure whether they are going to occur or not. Meaning that the percentage, if it is a one-off item, the percentage of it to occur is less than 50. If it is less than 50, then how are we going to be treating it? Then maybe we can look at how do we recognize these contingent liabilities in our financials. But we are saying that these are possible obligations whose existence will be confirmed by the occurrence or non-occurrence of an uncertain future event not within the control of the organization. Of course, we are expecting that by the time maybe if a certain third party takes us to court, you find that lawyers can tell and give us an evidence that maybe this one will have a 50% of winning it. If it is a 50%, 50 or 51, then we say that one is going to be treated as a provision because we already have chances of us losing the money. But if maybe the lawyers say that we are going to be having a 30% chances of winning that case, then we can record that as a contingent liability, meaning that 30% we are likely not to incur anything. But since we have that small percentage of something to occur, then we make sure at least we recognize it. But how do we account for that? Maybe before we go that we can try to complete these small notes, and we are saying that the contingent liabilities are not recognized in the balance sheet. The reason why we don't, because most of the questions are going to be rotating on these theoretical aspects, and they are very important because they are very unique. The reason why we don't recognize these contingent liabilities is that they don't meet the recognition criteria. We spoke about the recognition criteria, something being probable, and we said it must be above 50%. So if it is less than 50%, then it is not recognized as a provision. So that's one of the reasons why we don't recognize the contingent liabilities in our balance sheets. Then the other one we can talk about, their cost, we can't even determine them reliably, and that's one of the recognition criteria for the provisions. So what you have to understand is that if something is not a provision, then it's supposed to be either a contingent liability or a contingent asset. A contingent liability and a contingent asset, they are all accounted in the same at the same time. Because when you look at, maybe if someone has taken to court and the percentage of the company losing the case is 40%, it means it is already less than 50%. It is going to be treated as a contingent liability. But at the end of the day, the company is going to receive the money, because after losing the case, that person is supposed to pay back the company all the costs we incurred. Maybe if the court says otherwise, and maybe the court may say that let everyone share their individual costs, or they bear. No one should pay. But if the court says the other one is supposed to pay the other one for the money that was involved within the process, then you find that you are receiving some income. That's what we call an asset. But it is also an asset, but we are not supposed to record it because we are not sure that we are going to get that money, since the percentage is less. So if you are not going to record them, where do we put them? The accounting treatment for contingent liabilities is that we just disclose them in the notes. Maybe this is something new you didn't see from your financial accounting, but when you're preparing financial statements, we put some after the financials, we put some notices, and these notices have items that are needed by the users of those accounting information, those who are interested in our financials. But these items, they are not supposed to be incorporated into our financials. And one of them we looked at in the last standard, we said we had the disclosures of government assistance. We said something, if it cannot be quantified, we just disclose it And where do we disclose these items? We disclose them in the notices. We say that we received this and this and this from the government, but it can't be quantified. At least to make these users know that in the future something may happen. Of course, when you say, the best way you can quote this, you can say that we have someone who has taken us to court, but the lawyers are saying that the percentage of us losing the case are less than 30%. Meaning that these users of the accounting information, they are going to be understanding that at least in the future, if something happens, they already knew in the notes when they read those financials. So what are some of the things that we are supposed to disclose as far as contingent assets and contingent liabilities are concerned? Of course, they are the same. All of them, we disclose them in the notices. And we are saying we have the nature of the contingent liability. You say if it is a court case, we say the nature is it may be a constructive idea or it is a legal matter. Then you talk about the financial impact of the liability. If it is an asset, how much do you expect to get? If it is a liability, how much do you expect to give out? Then you talk about even the uncertainty itself. It was all about what? The court, the person took you to court for what? That's basically what you are supposed to be showing in these notices as far as contingent liabilities and contingent assets are concerned. And that's when that is done, it gives a good impression to these people who are reading, that maybe if something happens in the future, they are already informed. So by the time, because you know those users of accounting information, they use that information for many things. Others may use that information to find out whether they can be able to invest in the company. So if they don't know some of the things, they may also take you to court, and you again start bringing other costs. So you disclose everything there. That's why these companies, they are required to publish their books of accounts, especially those which are listed on the stock exchange. So I hope I have explained the contingent liability and the contingent asset. I'm not going to go into that. Maybe to look at something small here, it's all about the degree of certainty. And we have some categories that we can maybe talk about. We are saying that if it is 10%, the degree of the occurrence of a one-off item or case to occur, if it is 10%, then we recognize an asset, we recognize a contingent asset or a contingent liability. But if the percentage is more than 50% to 99%, we recognize a provision. We talked about that the provision is probable that the percentage is more than 50%. So if it is 50 to 99%, we recognize a provision. Then if it is below 50%, but it is also less than remote, maybe it is less than 5%. It is below 50, but it is again less than 5%, then we disclose a contingent asset or liability. But of course, if you try to look at there are some scenarios that you may find that something may be to occur, it is about, let's say, 45% or 48%. At least that one is near to 50. That's why here we are putting the 10% and we say we recognize an asset or a liability, because at least that one it is, but that is above 10%. Hope you can be able to use that information well. Maybe the last bit we can talk about under this standard IS 37 is basically the provision for reconstructuring. Here we are trying to look at, when you're talking about restructuring, you find people thinking about losing their jobs and all that, but basically this is a bit broad. It exceeds to that. And here we are talking about the restructuring. You may find there are also certain items that are covered within the standard, and there are others which are out of the standard. Maybe to talk about the ones that are out of the standard, we may talk about if, let's say, the company is developing a new idea. If the company is just developing or is just adapting a new system and they are replacing all the old systems they had, that one we can't call it a restructuring. If maybe these employees, they have been maybe relocated, someone has been in Ginger and has been maybe transferred to a certain division somewhere, You may find that someone has been working, let's say maybe East Africa, it's an international organization, now they are taking maybe to West or whatever. So those are not part of the restructuring. Because we recognize that and we assume that the business, it is still a going concern. But when you are talking about restructuring, something, it is ceasing to exist or it stops to exist. One of the things we can talk about is maybe we are closing a division. We had a branch, maybe it was an international organization and it had a branch, let's say in East Africa, and it was not performing. Or maybe it had a branch in Uganda, but the Ugandan branch is not performing. They can organize and they say, you know what, according to the performance of this organization for these years, we are going to close it. So when they are closing it, there are certain costs that we are supposed to incur. Because if you are closing a branch in Uganda, what about the people who have been working there? Are you going to make them redundant and you start incurring redundancy costs? Because they will be there, they are not working, but you are paying them. Or you are going to terminate their contract and make sure you pay the termination benefits. Even closure costs themselves, you may find that to close a company which has already started, you do something, you incur certain costs. So those are the things, some of the things we may talk about. The other one you may look at, if let's say it has been a company that does maybe different or produces more products. Maybe I can talk about Coca-Cola. It produces Coke. It produces the one without sugar, but you find that even sugar is more. Then they produce even, let's say, Minute Maid and all that. And you find that maybe they are seeing the product of Coca-Cola and the one for the one without sugar, they are more or less the same, and they try to remove one of the product and they say, let's maintain this. So if you are doing that, then what are the people who have been involved in that, in the production of that product which had no sugar, and you are removing it? So that's basically what are the things. How are we going to account for those costs that we are going to incur as a result of closing? If at all maybe the company has been sold, you may not even close, and they may say that, no, this Ugandan branch has not been performing, but let's sell it off. Of course, when you sell a company, you may find that some of the employees are going to lose their jobs, because the other person who is coming with different ideas. He may even change the products. Of course, when they change the product and you don't know what they are doing, you just go out, just leave the business. Those are basically some of the things that we can look at when we are talking about restructuring. Not all about losing jobs, but there are other costs that we incur other than the termination of the employees. Then, having looked at that, remember we said some of these provisions, we incur them, either those costs are going to come as a result of legal actions, or they are going to come as a constructive ideas. So these are just going to be the constructive matters, because it is the management that decides on what is supposed to be terminated and what is not going to be terminated. So that's why I was emphasizing that you make sure you understand if it is a legal matter, you understand it, and you find where do you get the evidence to confirm these percentages. Then if it is a provision for restructuring, of course there are conditions that are attached, or there are recognition criteria that we have for us to recognize a provision. We said we can't recognize it if the company is just relocating employees. The one who've been in, the ones who have been working in, let's say in Uganda, they have been transferred maybe to work in Kenya. That one we don't, it's like it's a going concern. If maybe they are developing a new product and they are changing, maybe they are just updating the system, there we don't call it. So hope you can be able, if they are marketing costs, they, you know, they are marketing costs you incur, and someone may think that they are going to be about restructuring. Of course, you may find that maybe the company wanted to maintain the name and is giving maybe a certain building that was constructed or it was having a branch, and the branch is now put somewhere, but they are giving out the building to, let's say, maybe to the government, because they wanted to regain their status in the market. So those are not supposed to be part. So what are some of the recognition criteria that we look at, that whenever you see them, you just know that this is actually leading to the person, to the accountant to be able to make a provision? One, we are saying that there must be a detailed formal plan for restructuring. It is going to be detailed. The standard says it is a detailed formal plan. So if it is detailed, what are some of the items that are going to be there? First of all, we have to know the parties that are going to be affected. If you are doing, if you are closing up a branch, let's say a Ugandan branch, what are the people who are going to be affected? You let them know. Then secondly, the likely expenditures. How much are we going to be incurring? The total expenditure we are going to incur as a result of closing this branch, in terms of terminating employees, making them redundant. Of course, when you're terminating, you know it is coming with the costs. Then you have also to specify the locations that are going to be affected. That's what we call a detailed plan according to the standard. Don't add in your words. Then the other one, of course, we have to communicate to the parties that are going to be affected. Maybe the employees that are going to be affected. Then the last one, we can look at the evidence of commencement of the restructuring process. If you are selling an operation, then we have to at least to be seeing the sales agreement. If maybe you are saying you are restructuring, you are removing the branch, let's not talk about that you are removing the branch because you want to, because by default, if you say you are closing the branch and employees leave, at the end of the day we see you operating there. It doesn't make sense. If you are closing, then we make sure that there is a commencement of the restructuring. It is detailed and there is effective date when it's supposed to, and when that effective date reaches, something ceases to happen. Then maybe we can talk about if at all there is a sale of an operation, someone is selling. You know, when someone is selling, when they are selling a company, some of the employees may remain there. Not all are going to be terminated. The standard talks about some of it, gives some lights about the sale of an operation, and we are saying that a provision is recognized when there is a binding sales agreement signed by the parties. You may say that we are going to sell this company. At the end of the day, you wanted people to leave and they disappear. When they disappear, the company still continues. Doesn't make sense. But the standard says if it is a sale, then we are supposed to be seeing the sales agreement. Then we are giving a note for the provision for restructuring. We are saying that a provision for restructuring is not made for the following costs, since it relates to ongoing activities of the entity. One, we are saying relocation or retraining of the current employees. Then the other one, we are talking about the marketing costs. Maybe the last one, we can talk about investment in the new system. If at all you are just developing a new system, we can't call it a provision for restructuring. So that's basically what the standard says, and it brings to our conclusion of the standard. Maybe to look at a trial number. It is December 2019, question 5B. You can try to look at that, and we see what we can be able to get from that. But that's basically the IS 38 provision for provisions, contingent liabilities, and contingent assets. That's basically what we can talk about as far as the standard is concerned.